Hello financial fans, welcome back to another stock analysis. Today we'll be covering Johnson Johnson stock ticker JNJ. Johnson Johnson is a multinational healthcare company that operates in three main segments: pharmaceuticals, medical devices, and consumer health products. The company was founded in 1886 and is headquartered in New Brunswick, New Jersey. Johnson Johnson pharmaceutical segment develops and markets a wide range of prescription drugs and biologics for the treatment of various diseases and medical conditions. The medical devices segment develops and sells a range of medical devices including surgical instruments, orthopedic implants, and diagnostic equipment. The consumer health products segment develops and markets a wide range of over-the-counter products including first aid and wound care products, baby care products, oral care products, and women's health products. Johnson & Johnson's mission is to improve the health and well-being of people around the world by developing innovative healthcare solutions that meet the evolving needs of patients and customers. They currently are sitting at a $408.7 billion market cap, and in 2022 they generated a revenue of $98 billion, and their dividend yield is currently 2.86%. 56% of their revenue comes from their pharmaceutical section, 27% from the medical devices, and 17% from their consumer products. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we're going to be looking at are the EBIT growth and the margin growth. The EBIT of Johnson & Johnson has grown over the years, going from $19 billion in 2013 to $25.7 billion in 2022. The average EBIT growth during this period was 4.1%, meaning no change in the margin of safety. The margin has stayed relatively flat with a small increase, going from 26.7% in 2013 to 27.1% in 2022. The average margin growth was 0.5%, meaning no change in the margin of safety once again. The next two ratios are the dividend growth and the payout ratio. The dividend has gone up, going from $2.44 a share annually in 2012 to $4.52 a share in 2022, and it's noteworthy that they are a dividend king at the moment. Their annual dividend increases on average were 6.4%, meaning no change in the margin of safety. This with a payout ratio of 66%, which is once again no change in a margin of safety. The final metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Johnson Johnson, this is a very low 6%, meaning a 5% deduction from a margin of safety. The return on invested capital is looking very solid, which is 15.3%, meaning another 5% deduction from margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Johnson Johnson. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow from Johnson Johnson going from 2013 to 2022. The average growth rate in free cash flow annually during this period was 3.57%, and I'm projecting an expected growth rate of free cash flow annually of 3% over the next 10 years. With this percentage, we can determine the future free cash flow for Johnson Johnson and determine the terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 8%. Doing this, we get a sum of free cash flow of $347.5 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $345.5 billion. All that's left to do then is to divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $129.22, which is a 17.6% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate annually of the dividends during this period was 5.86%, and I'm projecting expected growth rate in dividends for the future dividends for Johnson Johnson of 5%. I will be once again using a discount rate of 8% in this valuation. This gives us a dividend discount model price per share of $158.20, which is a 0.84% upside from the current price. So in this model, it's trading very close to its fair value. The third model that we'll be using is the Graham's revised valuation formula. In this model, we look at the earnings per share that Johnson Johnson is generating, growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a company with no growth is always trading at a PE of 7. This gives us a fair value of $77.44, which is a 50.64% downside out of this model. The fourth model that we use is the multiple valuation. In this model, we look at similar companies to Johnson Johnson, look at their stock price, and determine their PE multiple. And this way we can get the average PE multiple in the industry that Johnson Johnson operates in. All it's left to do then is to multiply it by the earnings per share that Johnson Johnson is generating, which is $6.74 a share. This gives us a fair value of $206.15, which is a 31.41% upside out of this model. And the final model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this are the dividend yield and the PE ratio. The average dividend yield of the past 5 years was sitting at 2.42%, and the current yield is sitting at 2.86%. So on this metric, it's currently undervalued. Looking at the PE ratio, on average it was 22.45, and the current PE ratio is 23.31, meaning on the PE ratio it's currently a bit more expensive. We still get a fair value of $168.09, which is a 7.14% upside from the current price. If you want access to all the models that I use in my videos, you can check in the description for my Patreon link. Anyways, getting that out of the way, let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, multiple valuation, and the mean reversion theory price per share, giving us an average of $147.82. Without a margin of safety, we would still get a downside of 5.78%, but we have determined our margin of safety earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, and another 5% for return on invested capital, giving us a margin of safety of 15%. Applying this margin of safety, we get a fair value of $125.65, and with the current price of $156.88, we get a downside of almost 20%. So in this case, it would indicate a sell, but you gotta understand that for a dividend king, you're usually paying a premium. So it might be a hold depending on what your strategy is. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.